Is the current AI bubble worse than the dot-com bubble? The answer is yes. I know what many of you are thinking, but these companies are actually making revenue. True, but the average retail investor isn't connecting the dots, and the math simply doesn't work. A bubble is defined as something whose size grows but has nothing inside. We are witnessing AI insanity. In this video, I'm going to reveal exactly why this bubble is similar to, and ultimately worse than, the dot-com era. And probably more importantly, I'll give you 3 simple, fast steps you can take to protect your portfolio. With a simple analogy to understand the core financial disconnect. Imagine Joe Jr., an honor student who just graduated high school. He's headed to AI University to major in engineering, certain he'll get a job making $100,000 a year. Fantastic future, right? But here is the problem. AI University charges Joe Jr. $1 billion for tuition. Do you think this is a good deal? The answer is obviously no. There is zero chance Joe Jr. can pay back that $1 billion over the next 30 years with a $100,000 per year salary. The math fails. This analogy represents the core of the AI bubble. AI University is NVIDIA. Joe Jr. is OpenAI. Sam Altman, the head of OpenAI, says they need to spend trillions of dollars on infrastructure over the next 2 or 3 years. Now, you might assume that because everyone uses ChatGPT, they must be making trillions of dollars. But you would be wrong. OpenAI's annual revenue is currently only about $12 billion. When you look at the industry as a whole, estimates suggest the total annual CapEx spending required for infrastructure is around $500 billion per year. But here is the killer fact. The industry aggregate total revenue is only around $15 billion to $20 billion. So, we have outlays of $500 billion per year versus revenues of $20 billion per year. In finance, we call that dog don't hunt. Look, nobody is disputing that AI is the future, just like the internet was the future in the 1990s. But being the future doesn't prevent a bubble. In the case of AI, the problem is intensified because there is no competitive moat around these businesses. For most people, AI like ChatGPT is used somewhat like a search engine. But what prevents you from moving to Google Gemini or Claude if they offered a slightly better price, say $10 a month instead of $20? Not much. AI, especially in its current form, is a commodity. The only way to outcompete on a commodity is price. We could easily see a world where prices drop further and further, meaning even with exponential growth in AI adoption, the actual revenues could fall from $12 billion to almost nothing. And don't forget the infrastructure being bought by these companies becomes nearly obsolete in 2 years, forcing constant CapEx spending just to keep up. I claim this AI bubble is even worse than the dot-com bubble. Here's why. The US economy is far more dependent on these asset prices today. NVIDIA alone has accounted for more than a third, specifically 34.5%, of the S&P 500's market cap gains this year. If you're passively investing in an S&P 500 index fund, which is what smart investors are told to do, you're actually funneling money directly into this bubble. Because the S&P 500 is a weighted index, a greater percentage of every dollar goes to the largest companies. Right now, the MAG 7, and especially NVIDIA, around 8 to 9% of all S&P inflows. This creates a self-perpetuating feedback loop, where the biggest companies keep getting even bigger. Not from real investor choice, but simply because the algorithm keeps buying more. If the AI bubble deflates, it won't just impact NVIDIA or OpenAI. It's going to drag down the entire S&P 500. The broader economic implications are massive. The top 10% of Americans own 87% of all stocks, and their spending has been holding up the economy. If the S&P 500 falls, these asset owners stop spending like drunken sailors, and the aggregate demand that's been keeping us out of a recession collapses. In fact, recent GDP growth, 4%, in the US was largely due to this AI-related capital spending, which now represents 1% of the overall GDP. Data center capex accounted for more GDP growth in the first half of this year than all consumer spending. The whole system is interconnected and highly dependent on this narrow, overvalued sector. So when is the marketplace going to realize the math doesn't work? The problem is nobody can determine when. These stocks could absolutely go higher, doubling or quadrupling over the next year or two, just like we saw in the late 1990s. The real question isn't, can the price go higher? Whew. The question is, does the risk-reward make sense right now? The answer is obviously no. Right now, the market is focusing only on the perceived balance sheet assets, the $1 billion IOU that AI University received from OpenAI, and ignoring whether OpenAI can ever pay that debt back. The marketplace hasn't focused on the viability of the cash flow. We also see issues in the very architecture of the technology. Since AI relies on probabilistic models, hallucinations are unlikely to ever be fixed, even with perfect data. Furthermore, LLMs are inefficient by design, burning huge amounts of GPU resources. Companies like CoreWeave, a major cloud provider, are relying on NVIDIA financing and leveraging GPUs as collateral, creating a tightly wound, fragile financial structure. So, how do you protect and grow your wealth in this environment? The good news is, it's pretty easy. Do the opposite of what everyone tells you to do. First step is to use critical thinking. Don't be a brain-dead robot zombie. Financial planners tell you not to think and just dump money into the S&P 500. Instead, seek mentorship and base your decisions on the fundamentals of investing. Second steps is to buy undervalued companies. You must look for undervalued companies instead of blindly buying high-flying AI stocks that are clearly in a massive bubble. If the market crashes, these companies will go down a lot less than the bubble stocks like NVIDIA. The final step, and most importantly, know when to fold. Avoid the mantra of buy and hold. That advice worked when valuations were cheap, like in the early 1980s, but the market is wildly expensive now. You have to buy, sometimes hold, and sometimes fold. You must know when to walk away. And right now, looking at the S&P 500, I would run away. The math does not work. The risk is high. The concentration of the AI bubble in the S&P 500 makes this a major systemic risk to the entire US economy. If you focus on the fundamentals, the revenues versus the necessary capex spending, you can clearly see the danger. The question is not if the bubble will pop, but when. And does the risk-reward make sense for you right now? Let me know in the comments below. Do you think this AI bubble will burst in the next 12 months? If you found this insightful and want to learn more about contrarian strategies that help navigate these markets, make sure you hit that subscribe button and click the link in the description for more resources. Thanks for watching.